Steve, what's the latest? Where are we at in this trade dispute? And it's going to be a very expensive game of chicken they're playing.
Yeah, game of chicken is what they're calling it, because we have a couple of very key dates coming up on the threats, of course, coming from the United States, and then retaliation promises from the Chinese. So this Friday, we're expecting the Department of Treasury in the United States to announce a list of restrictions on Chinese investment in the United States to complement what's already in place under CFIUS. And these are also likely to target China's Made in China 2025 sectors that, of course, the United States is accusing China of violations of intellectual property rights. So it could get a little bit more tricky by this Friday. This is in addition, of course, to the July 6th deadline on the first round of tariffs that the Trump administration has threatened on $34 billion worth of Chinese imports. And then, of course, then there's another 60-day review on another $16 billion of Chinese goods. And then on top of that, of course, Donald Trump's administration has asked the U.S. Trade Representative's office to identify another $200 billion worth of goods that could potentially get a 10% tariff slapped on them. So, yeah, we're just getting into the really heated part of the realization of tariffs that have been threatened. Of course, now China has vowed to take reciprocal steps. We did get a report, though, yesterday from the South China Morning Post out of Hong Kong saying, though, that Beijing will not necessarily target U.S. companies that are doing business in China, because the thinking there is that would be counterproductive to China's efforts to, of course, get more international investment into the country.
And Steve, we also got that much anticipated triple R cut from the PBOC over the weekend. How much does this actually soften the blow in what we've been seeing in the China markets here, which really have been dogged by these trade tensions?
Yeah, absolutely. This is a bit of a preemptive move, of course. We don't know how deep and how far these trade tensions are going to go and hurt the economy. The economy is already showing signs of some slowdown. But this triple R cut is very targeted because they also don't want to exacerbate the risks in the economy. They actually want to limit the risks. So about $700 billion is what this 0.5% cut in the reserve ratio requirement at banks is going to inject into the economy. $700 billion. $500 billion of that will be at the larger banks, but with instructions that they must go into this debt for equity swap, which is something that banks don't necessarily want to do. They're going to assume bad equity and write off some bad debt. So that's really kind of shady for the banks. But, you know, it's policy-driven lending here. So those big 5 state banks and also 12 joint stock commercial banks are going to have to up their commitments to this debt for equity swap at larger, heavily indebted companies. But in the statement from the PBOC, not to so-called zombie companies. So we'll have to see. The other $200 billion is going to be targeted, or for the smaller banks, targeting lending into smaller companies to give a boost to those small to medium-sized enterprises that might be suffering right now in what could be a slowdown.